I think the world, generally speaking, over the last 3 or 4 years has come to appreciate that Canadian oil and gas, and we're amongst the world's largest oil and gas producers, and we do it very responsibly and sustainably. That's becoming increasingly attractive to investors. And more recently, now as a result of this Mark Carney-led government in Canada, which is much more pro-business, we're now getting oil and gas deals getting done in Canada that we hadn't seen for 10 years.
All right, welcome back inside our proactive newsroom. And joining me now is Dean Orrico. He is the Chief Executive Officer from Middlefield. And Dean, it's great to see you again. How are you?
I'm great. Thanks for having me.
Yeah, good to have you along. Excited to learn a bit more about what's going on as far as your ETF is concerned. Lots of news to talk about as well. Energy market is always a hot topic right now. Give me some thoughts on where you're seeing the energy market at.
Well, there's no shortage of news, and it's hard to know what to believe. Do we have a deal? Don't we have a deal? And as a result of all the rhetoric, oil prices have been moving around quite a bit. And today, as I look at my screen, hovering around $77 a barrel WTI. And that's a very healthy price. And in our view, we expected that if a deal were to be struck and the Strait of Hormuz opened, then oil prices would come down. And we think that the days of $50 and $60 oil are in the rearview mirror. So as we look at the short to medium term, something in that $70 to $80 range, we think is not only a reasonable price, but it's actually a very healthy price for the oil and gas businesses we own in this portfolio. Our fund today actually has somewhere close to 35 to 40% exposure to energy. But the way to really understand that exposure is that about half of it is more linked to oil and gas prices because that's where the producers are. The other half of it is really linked to energy infrastructure companies who are also doing very well, but they really don't move with the price of oil and gas prices because they sell their capacity based on a tolling arrangement, regardless of where oil and gas prices go. So it's that producer part of the component that's actually been reacting positively to the unfortunate wars in the Middle East, as well as the ongoing war in the Ukraine. And I think the world, generally speaking, over the last 3 or 4 years has come to appreciate that Canadian oil and gas, and we're amongst the world's largest oil and gas producers, and we do it very responsibly and sustainably. That's becoming increasingly attractive to investors. And more recently, now as a result of this Mark Carney-led government in Canada, which is much more pro-business, we're now getting oil and gas deals getting done in Canada that we hadn't seen for 10 years. So the narrative is certainly improved as far as Canadian energy goes.
Because of where the Strait of Hormuz was and all the oil that's coming through here, do you expect to see sort of a glut all of a sudden on the market? 'Cause usually when you get into the summer months, it tends to stretch out a bit. Gas prices a little higher. It seems like it's might be the opposite this year.
Yeah, we certainly don't expect a glut. You do have some spare capacity out of various Middle East nations, including the Saudis and the Qataris. So that's going to help. And I think that's one of the reasons why oil prices have moved down somewhat, in addition to the rumored deal, which should be signed by tomorrow between the US and Iran. So that spare capacity is helping buffer some of that lack of production and transportation of oil through the strait, because we all know that getting back to where we were pre the war in Iran is going to take several months. Trying to get production back up to the levels that we were pre the war in Iran is going to take until the latter part of the year. And some of that spare capacity that's sitting on the sidelines, we think is going to help bridge it. And that's why oil prices have come down to the mid 70s.
Okay, let's talk about the real estate market. What are you seeing there?
Well, this has been an area that we've been focused on at Middlefield really since our founding almost 50 years ago. And we focus on the public REITs, and the fundamentals, by and large, in the real estate market in Canada continue to be extremely good. Our exposures in areas like seniors housing, where there's more demand than there is supply, it's hard to add new supply, so hence rents are going higher. Industrial properties as a result of ongoing growth in e-commerce, demand for data centers. These industrial big warehouse type facilities are getting increasingly more valuable. Rents are going up there too. And then even grocery anchored shopping centers. This is where we've had, again, very little supply. You've had huge growth in population in Canada. So there's now more and more demand for necessity based grocery anchored centers. Rents are going higher there as well. And that's really where we have our exposure. The multifamily area has been struggling somewhat, but I think we're forming a bottom. So the bottom line is our Canadian REITs are up quite a bit on a year to date basis, well over 10%. We've had now three takeovers of Canadian REITs in the last 12 months. Another one rumored that is going to be acquired by Blackstone just announced or came into the news last Friday. So there's good value there. And I think smart money is starting to take advantage of that. And the markets are starting to respond to it as well.
Okay. And what about the financial sector? Because obviously that ties into a lot of what we're talking about already.
Well, there's no doubt. The financial sector is by far the largest part of the Canadian equity market. Our Canadian banks, I would argue, are amongst the strongest of any banking sector globally. We've got amongst the highest return on equity. We've got amongst the highest capital ratios. Even though our GDP numbers are down somewhat, Canadian banks continue to be quite conservative in terms of how they lend money. And as a result, their earnings are turning out to be just excellent, like really, really good. Wealth management is firing on all cylinders. IPO activities picking up, so capital markets are working well. And as I say, the loan book has held in very, very nicely. So overall, our Canadian banks are up on a year-to-date basis. So some of our holdings in this fund, like a Royal Bank of Canada, is up 20% year-to-date.
Hmm.
We've got Bank of Montreal up 35% year to date. So these businesses are doing really, really well, and the market's starting to recognize that.
Well, lots to talk about and lots to keep watching over the months to come. Dean, thank you so much. Great to see you again.
Great. Thanks for having me.
All right, Dean Orrico, the Chief Executive Officer for Middlefield.